We launched Tabula because we felt that there was a gaping hole in the fixed income space, passive fixed income, particularly in the ETF space. We thought that what we had seen in the equity realm with the growth of both plain vanilla passive, smart beta, and now active strategies was not being reflected in fixed income. Fixed income is a massive asset class, double the size of equities, very complex, and fundamentally underrepresented in the passive and ETF space. So we thought, looking at what had been done so far in fixed income ETFs, that it was quite interesting what people had done in plain vanilla basket cash products. So if you look at the offering in investment grade corporates, high yield, government bonds, emerging markets, inflation, you will notice that most of it are cash basket products, by which I mean that it's a group of cash bonds that have been put together following an index to deliver broad exposure to that grouping of in that space. From our perspective, there are many differentiated exposures that are not offered in those products. And we thought that delivering fixed income factors and smart beta in the fixed income space was the next logical place to go. Today, passive fixed income plays a relatively straightforward role in delivering exposure for investors to baskets of cash bonds that are considered to be liquid and therefore benchmarks in their space. This is obviously helpful, particularly in an industry where the liquidity of the underlying securities has been in question. And to be able to trade a single instrument giving you exposure to a basket of sometimes relatively illiquid bonds makes a lot of sense. Where is it going, we think, is to a place where you can gain exposure to a much wider range of quite targeted fixed income exposures across the credit, governments, inflation, and emerging market spaces in the form of ETFs that use a broad range of tools. Now, if we remember, cash bonds are only a small part of the broader fixed income universe. There are a lot of derivatives and contracts and futures that are used in order to gain exposure and that a traditional fixed income investor uses. Those are generally underrepresented in fixed income solutions for ETFs. We think that's where the market is going. If we look at the existing providers of fixed income products, there are really 10 that represent most of the assets and 30 fixed income ETFs that represent half the assets. This is a very concentrated offering, and we at Tabula felt that as a new provider, we could quite rapidly have an impact on that space, whereas in other exposures, it might be more difficult to have an impact early on. Switzerland, Germany, Austria are all very important to our business for a few reasons. One being the range of investors in the space, the fact that there are a number of very sophisticated investors who are extremely knowledgeable about fixed income as an asset class, who understand the complexities of the asset class, who understand the nuances of gaining exposure through different tools, and who are effectively demanding more precise and compelling tools in the space. Obviously, investors across Germany, Austria, and Switzerland range from insurance and pension funds, asset managers, banks, private banks, wealth managers, family offices. And each different grouping has different needs. But of course, across the spectrum, the money is managed by professionals, people who are very sophisticated. There's only a limited amount of use of the fixed income tools by individuals. And therefore, there's a huge appetite to use more precise tools to match people's ultimate allocation views. And this is the biggest challenge. If we think in terms of investment grade credit, the challenge that people have had when buying exposure is getting a yield in euros where the underlying government rates are negative. There is no question that credit offers value above and beyond government bonds. There's no question that corporates trade at a spread to government bonds. But ways of harnessing this value without just purchasing fixed rate bonds have been limited. And we think that if you can identify that credit, in this case, a credit factor, which is the fact that a risky issuer pays a higher amount than a risk-free issuer, such as a government, then you know that that relationship is going to remain positive in all normal circumstances. Once you've identified a positive difference, it's just a question of capturing that in a way that's compelling to the investor.